Hello. Um, in this study, actually, I want to show my analysis whether someone like myself should buy a house, collect rent, pay the mortgage, and let real estate value grow up, um, or do its comparative investment, invest in stocks or S&P 500, and see in the long run which investment option beats, which is superior than the other. In part one, we'll focus on S&P 500, and in part two, we'll see housing market side. For S&P 500, I collected that official data from given this website. Uh, Data is from 1928, monthly data, monthly return. Assumed that someone invested $100 by then, um, and also adjusted CPI. CPI is basically Consumer Price Index, which is basically another definition of for inflation. To accommodate like net return, how much someone would make. Further for that, I divided that in sub bands. Like someone could say, oh, 1928. Why to do that old analysis? This is basically since 1928 till December 2023. We can see at the end from here. It is a little bit slow, but please bear with me. Yeah, August 2023 till that. So it's not only 1928, couple of years data. Um, Further for analysis, I divided 5-year investment plan, 10-year, 15, 20, and so on. Basically, 5-year investment plan assumes that bands of 5 years, like someone invested, let's say 1928 to 1933, 1929 to 1934. Similarly, 2018 to 2023, 2017 to 2022, like that kind of. And 10 years are 10 consecutive years, that band, which goes, let's say, 2013 to 2023, 2012 to 2022, 2011 to 2021, and goes all the way back. And same structure goes for 15-year, 20-year investment plans. And all returns are inflation adjusted. That's why we accommodated CPI factor. If we see the return, um, that is follows the same structure. Here is its detailed analysis. For example, if you see 5-year plan, because 5-year would be like 60 months. That's why this column is still blank. We'll see it should start around 67 row number. Yeah, around 60, 20, row 67 it begins. Same structure goes for 10, 15, and other years. And whole this sheet includes that data structure. Then I included how would that flow, like if someone layperson wants to just understand, okay, in a nutshell, tell whether I what I should expect if I invest in S&P 500 or not. uh, Although stocks return, no one gives guarantee, um, but historic return, if we see, we can do that for our analysis, and that's what we are doing here. um, the flow of probability, we in stats we call that probability distribution. Like, okay, if someone says I can win or lose randomly, that could be probability generally as 50-50. But if someone says, okay, I have seen the cards, you can win by it with probability of 80%, that means there is very strong chance and someone can take risk. um, Likewise, this probability distribution graphs, they basically gave us deep insight, what would be the probability and what to expect. So if we see net growth on x-axis for all graphs and on y-axis probability distribution, uh, then we can see that approximately, let's say, 5-year graph, um, it's it's zero between zero point 0.2 and zero point 0.25. So that means around 20 to 25% probability is that a 5-year investment plan will return nothing or will remain in negative. That is what it shows. Similarly, let's say above this, if we see someone can say that between 10 to 15% is the probability of getting return more than 1.5 times or 150% return on that. Between that is more probability, like approximately 60% kind of collectively if we see. And how much is that? That is here to expect return in this band. Likewise, and one thing, two key points to remember, for 5%, getting return in negative is 20 to 25%. Now let's go to 10-year investment plan, how it has performed so far. Its probability to go zero is still between 10 to 15%, but here, worst case, it would have flipped, could have lost almost 50%, but here it could have lost only 21%. Now, if we see its distribution, like it could go in negative or zero, probability is 10 to 15%, but return probability approximately, let's say, 300%. That is approximately this much, 10%. That's fair. And all most of is in this structure, which is approximately 1.5 to 2 times we can expect return. And in 15%, same, to go zero, probability drops to close to 5% only. And to earn more, 5% similar gives us like 8 times for 20 years. That is here where it gets interesting. Probability to get zero is almost zero. So it's almost guaranteed that for 20-year investment plan, either capital will retain its value, inflation adjusted, or it will grow. It will not be negative. Then of course, we don't want just to let investment retain its value. We want it to grow. We'll see that in this probability. So let's say its probability to grow in 20 year more than 20 times is almost only 5%. But most of the probability is in this band, if we see. That means for 20 years flow, it can approximately, for its probability to grow between, let's say here, almost 400 to 800, that is almost 0.3, more than 0.3. So which is collectively, if we see, more than 30%. So that is typically what we should expect. Usually we consider anything less than 5%, that is outlier. So we can say our probability to make good return is in this band, in this area. And the probability to get zero is theoretically zero. Same goes for 25 years. Probability to get negative return was already turned to zero almost in 20 years. So for 25, 30, and so on, that will remain zero. And to grow above, probability that's margin growth, like to get 10%, 10 times growth. Let's say invested $100 to expect $1,000 after 25 years, that's probability is 40%, which is very strong. Um, Likewise, to get that like 30 times, that's very low probability because that comes to 5%. So typically we can say anything above 10% kind of probability, that's reasonable, which should be like approximately 5 times to 20 times, kind of 25 times. So that is its structure. For 30 years investment plan, there are very few people who might be investing for 30 years, but just for interest, we can see this too. Probability to get even 5 times, that's almost guaranteed here. That means, um, and probability to get like typically its probability is like if we break even, let's say at 10%, it shows like it will grow 15 to 35 times. That is like 15 to 35 times. That's probability is more, all above 10%. So we can say 90% of is the probability that we will earn 15, somewhere between 15 to 35 times of our investment. So if we invest $100, it would be either 1500 to 3500, somewhere between that. High likely will be approximately in this range, which is around 20 to 22% times, kind of. Yeah, that is the analysis of investment part. In a nutshell, we can say if we're investing in the long run, then invest probability to get balance out in 20 years is definitely guaranteed. And above that, its growth up to 5 times, probability is 45%. And typically we should expect somewhere between, let's say here, which is almost 3 times to 15 times, that kind of. And that is what structure these banks use, and they plot those fancy graphs, and it is the same calculation in simple in a simple way. Thank you.